Welcome. My name is Michael Norris. I'm the senior agent and president of the Norris Financial Insurance Group. And my team knows how excited I am today because I get to talk about one of my favorite financial products on the market, the Retirement Account Protection Policy that offsets market volatility, allowing you many times to live off up to 40% more in retirement. Because I think about it as climbing a mountain. Everybody wants to get to the top of the mountain. Everybody wants to see that scenic view. Everybody wants to have that day which they do not have to show up to work. We call that the accumulation phase. However, we have to make sure we can make it down the mountain safely. That we call the distribution phase. Most people think about this as two different journeys, but really it is one continuous journey. There are two rates that make up everyone's retirement income, and both are equally important, the accumulation rate and the distribution rate. Understanding the distribution determines how you pack your bag in pre-retirement. In other words, begin with the end in mind, because there is a problem that most people don't think about. How do retirement funds react to a fluctuating market when money is being withdrawn for income? Let's look at an example. We have our friend Joe. Joe worked hard, did great with his family. He's done. He's ready to retire. He's at the top of the mountain. He's got $1 million in the bank. Joe's in great health. We think he's going to live about 30 years. The time in history when Joe retired, the average rate of return was 14.84. So he figures he can easily take out 10%. Well, this is what he's thinking because everybody's been talking to him about average rate of return. Year one, average rate of return, 14.84, takes out $100,000. His account balance at the end is still over $1 million. By the time Joe passed away about 30 years later, Joe thinks he's going to have about $15 million in the bank. Unfortunately, this is not reality because the market fluctuates. The time in history we're talking about is 1970 to 1999. Average rate of return for the S&P 500 was 14.84, and this is what it looked like. When he retired in 1970, the market did 3.99. Hey, in 71 and 72, it did great, 14.33, 18.94. Then we hit those years. 73, negative 14.79, and 74, negative 26.54. Don't forget, negative 26.54 is not the lowest the market has dipped. It's gone below that a couple of times, including 2008, when it dipped almost 38 points. But back to our graph here, we can tell the rest of the time the market was good. Went up, went down, we had some good returns. Take all this, add it together, divide it by 30, and that's where we come up with 14.84. So let's take Joe and put him into reality. He retires, and January 1, he takes out $100,000. Well, December 31st, market didn't do so hot. It did 3.99, so his average account balance when he was done was $935,910. All right, year two comes along, 14.33. Year three comes along, 18.94. We're happy with those gains. Takes out this $100,000 by the end of year three. He's got over $1 million in the bank. He's back to where he started. He's happy. Then we hit those years. Year four, negative 14.79. Takes out his $100,000. You can tell where he winds up, about 782 and some change in his account. Then year five, negative 26.54. Takes out his $100,000. Joe's account balance is just a little bit over $500,000. Even though year six and year seven had great gains at 37.25 and 23.67, his account balance could never recover from the negative years. So as a result, by the time he hit year 14 and 15, our friend Joe ran out of money. I'm sure you've heard of the 3 to 4% rule. This is the rule that says if you're going to live about 35 years after retirement, you can only safely take out about 3 to 4%. If you take out 3%, you have only about a 5-6% chance of running out of money prior to death. Take out 4%, you probably have about a 10-15% chance of running out of money prior to passing away. If you're taking out 5, 6, 7, 8+% each year, your chances of running out of money prior to passing away is significantly increased. So what does this look like? The 3 to 4% rule, we have $1 million times 3 to 4%. That gives us $30,000 to $40,000 a year to live off of. This is not realistic for most people. Most people need 7 to 13% to live off of in retirement. So $1 million times 7 to 13%, they're really needing in this scenario about $70 to $130,000 a year. How do you do this without a high probability of running out of money? Well, we need to set up our accounts this way. First, we need a liquid asset account. That's going to be our checking, savings, money market. This is our security blanket, our emergency fund, our opportunities, our vacation plans. Then we need to have our retirement assets. This is our 401k, our IRA, our stocks, our bonds, our annuities, real estate we might own, and any business interests we have. Then there needs to be a third bucket. That is our volatility protection plan. In order for this to work, it has to never lose money, produce at least a 4 to 6% return each year, must be in place before retirement, and has to be tax-free when withdrawn. So in other words, when we withdraw the money out of that, it has to be tax-free regardless of our income. And of course, most of you know there's only one product on the market that does that, and that is a permanent life insurance policy. So by combining our volatility protection plan with our retirement assets and balancing this out, we can increase our retirement income. So let's see how this works. Without a plan, we've got $1 million in our 401k. We know we can take out about 3 to 4%. So let's just half this down the middle and say 3.5 gives us $35,000 a year to live off of. With a plan, we don't need the $1 million. We need $750,000 in our 401k because we're going to withdraw about 10% because we have a volatility protection plan off to the side that has a death benefit of $750,000 and a cash value of $250,000. If you are not familiar with permanent life insurance policies, the way they all work is they have a cash value account. And many times when designed correctly, depending on your goal, this can produce a nice rate of return safely. So what does this look like? Year one, we take out $75,000. But by the end of the year, it didn't do so hot. So we're going to let our retirement account rest, and we're going to take that money out of a volatility buffer. Next couple of years, it does great. So we're taking $75,000 out of our 401k retirement plan. Then the market dips. So we're going to let our retirement rest, and we're going to take it out of our volatility buffer. You can see how this works. Market does great. Retirement account is where we're going to withdraw. Market not so great. Volatility buffer. So we're letting each of them rest as we're taking money out of the other. So what does this look like? Remember, our account balance in this case is not $1 million we're starting out with. We're just starting out with $750,000, withdrawing about $75,000 a year. So January 1 rolls around, we take out $75,000. However, the market only did 3.99. So the next year rolls around, and January 1, we're not going to touch our retirement account. We're going to touch our volatility buffer. After that, next couple of years, market did great, 14.33 and 18.94. So we're happy there. But then we hit that negative 14.79. We're going to let our retirement account rest and take it out of the volatility buffer. I purposely designed this particular scenario with only 2 years of volatility buffer protection. Most of our clients have many more years than this. However, in this case, it's just with 2, and I want to show you the power of the volatility buffer. Because even with the next year being negative 26.54, we still, by the time 20 years later roll around, have almost $1 million in the bank at 932,728. Remember, we didn't start out with $900,000 in our retirement account. We started out with $750,000. That is the power of the volatility buffer. Because without a plan, we withdraw $75,000 a year. Same idea, market hits, we can't recover, and then by year 14, we're out of money. There's another option that some people like. Once again, just to review, without a plan, $1 million, we're going to take the 3 to 4%, half down the middle, live off of $35,000. With a plan, we've got $750,000 in our 401k. With this plan, we're going to spend every dollar we have so that by the time we pass away, we have $0 in the bank. However, we have our volatility buffer life insurance protection plan off to the side that's got $750,000 death benefit. When we pass away, it's going to kick in because we have a spouse. So once again, when we're alive, we're spending and enjoying our life. Once we pass away, the life insurance policy kicks in at $750,000. Our spouse now has $750,000 to live off of for the rest of their life. The decision for which option or combination of options to use for retirement income is made at the time of retirement. In other words, you're not deciding right now if you're going to do option one, option two, or put the two together and make it a hybrid strategy. Right now, you're simply getting ready so that when the time comes, you have the ability to make the decision. No matter which option you choose, you are so much better off than being limited to the uncertainty of an invested retirement asset only strategy for retirement income. In other words, that 3 to 4% rule we talked about earlier. Having a retirement asset protection policy gives you the ability to create potentially higher, more secure retirement income. The big picture strategy that you implement today will directly impact your retirement income. The next step, my team and I would like to design a personalized illustration for you to show you how a retirement account protection policy can work. Below this video, it could be above this video, depending on what medium you're watching this on, should be a link to click to my calendar. You just click on the calendar link, schedule a time for you and I to talk on the phone for about 15 to 20 minutes. Also, if you gain something from our time together, please tell your friends. Most of our business comes from referrals, and I would appreciate that. I hope you have a great day, and I look forward to talking with you for about 15 to 20 minutes. Don't forget, my calendar link should be below or above this video.